Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video I want to talk about 10 different companies that are either undervalued or fairly valued. As I was about to record this video, this message came through. So Nvidia apparently is up 4.5% after unveiling 3 new GPUs in the AI PC race. And Nvidia to go all-time highs is absolutely ridiculous because it's already been going up so much in the last few months. But I've got today 10 different companies that are undervalued. But before we get to that, I would like you to subscribe to the channel, like the videos of course, and join us on the Patreon account where you get access to all the buys and sells, and you get updated watch list. You got the ETF trackers, you got the private Discord, you got top of that you get the Sharia compliant investing ebook, where if you are new to investing, I would definitely recommend you to look at that because it has quite a lot of information that you can actually hopefully learn something from, inshallah. Right, let's get started with the 10 companies. I want to make the video as short as I possibly can. So as usual, we're looking at all of these things. So the market cap, the moat, the price, the PE ratio, the dividend yield, how often they've increased that in that dividend, how much they will pay you, the safety of it, the return on equity, profit margins, if they have any free cash flow. The reason we like free cash flow is companies that have excellent free cash flow, and you will see some of them do absolutely amazing, have amazing free cash flow today, is because they use that money to pay off any dividends, to pay off their debt, to of course increase the buy back their own shares, to acquire other businesses, to to invest in the business as well. So there's a lot of things they could do with free cash flow. So that's why I like. We're going to check the 10-year total returns from the last 10 years. And the reason we do that is because it kind of gives us an idea of where the company has been, and growth estimate for the next year, and growth estimates for the next 5 years, as well as Morningstar valuation. Like I've always said to you guys, I trust Morningstar quite a bit. Of course, you always have your margin of safety, but I feel like they do have excellent margin of safety. A lot of the things they predict is always kind of they haven't let me down yet, basically, but I always take into consideration at least the 5 to 10% depending on the companies that I'm looking at. Right, so let's get started. I'm not going to read everything, so I'm just going to kind of give you a summary. If you would like me to do a video on one of the companies or some of the companies that we're going to talk about today in more detail, let me know. I'm more than happy to do that. So the first company we're looking at is MasterCard. MasterCard is a technology company that provides the transactions that we use whenever we use a bank, basically, and their cards, basically. It has a market cap of $393 billion. It has a wide economic moat, and current price is 417. Now the PE is quite high, it seems, okay, but when you compare it to the 5-year average, it's actually not that bad. Now in terms of dividend yield, very low. Dividends is growth side way absolutely amazing, and you get $2.64 for every share of this company that you own. It has 100% safety, which is absolutely fine. Profit margin, return equity, absolutely wonderful, and almost $10 billion of free cash flow right now. If you own this stock for the last 10 years, you would have made 18, basically total return of 18% every single year. Growth estimate for the next 5 years is absolutely wonderful. So 17 next year, 21% after that. Fairly value right now, $421 per share is what they're expecting. Next one is the oil giant, is ExxonMobil Corporation, $410 billion. It has a narrow economic moat. Prices right now just above $100 per share. Dividend yield of 3.7. The dividend side of it is absolutely amazing. No issues in terms of safety. Profit margin is good. Return on equity is excellent. They have 37, almost $38 billion of free cash flow right now. They have not given him much return in terms of total return in the last 10 years. But when it comes to next year, it's flat. The year after, or the 5-year after that, is almost basically you gain about 11% negative on the basic growth side of things, and 17% discount right now, $123 per share. This can easily change. Okay, this can easily change if the basic oil prices start going up, and of course there's more demand for oil and blah 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 because of what's happening in 2021 and 2022. Basically the company has grown so much in the last 2 years. So probably that's what's going on, and the oil prices demand is not as strong as it was before. Next one is Visa, 523 billion market cap. It has wide economic moat. Current price $260 per share. EP is 31, so it seems slightly cheaper than MasterCard, and it has a higher dividend yield than MasterCard. And in terms of dividend side of it, absolutely no issues. 99% safety. Profit margin, return on equity, absolutely amazing. $20 billion of free cash flow right now, closer to 20 billion, and 17% of total return in the last 10 years, 13%, 14% after that for the next 5 years. So every 5 years, every year for the next 5 years, basically you'll get about 14% total return. Growth side of things, sorry. Fairly valued right now, $260 per share is where the price is. Medtronic is the next company. I just watched an interview that the CEO has done. They've got a lot of things in the pipeline coming up, and this is one of the best medical devices companies out there, and one of the biggest. So 112 billion market cap, wide economic moat. Current price is $86 per share. So that seems for me is basically quite low. Dividends are absolutely amazing, no issues with that. 45 years of increasing that. 5 more years, this company will become what's called a dividend aristocrat. This dividend king. They're already aristocrats. Aristocrats are companies that have increased their dividend 25 years or more. Annual payout right now $2.76. Safety of 99%, so no issues there. Profit margin, return equity decent. Profit free cash flow right now is $4 billion, which is quite nice. 6% return in the last 10 years. Almost 6% return this year. Next year, and then 3.4% after that. That's what they're expecting. 24% discount right now, $112 per share is where the price should be according to Morningstar. Next company we're looking at is Robot Technologies, $55 billion of market cap, wide economic moat, $526 per share right now. P is just 19. Dividend is not great. So if you're after the dividend growth, this company is absolutely amazing. But if you're after the yield, that's very, very low. $3 per share, that's what you will get. Safety 98%. Profit margin, return equity is decent. Free cash flow $1.4 billion. Total return in the last 10 years, you get 15%. 10% after that, next year. And then growth estimate for the next 5 years is 11%, which is quite nice. Fairly valued right now, $560 per share is where the price should be. Next one is a company that I own in my portfolio. Now we're looking at the US version. That's Unilever, $122 billion of market cap wise. Wide economic moat right now is about $50 per share. PE is quite low, 14. Dividend yield of 3.8. Payout ratio 63%. Latest increase, I've got it from Simply Safe Dividend, but they have not cut the dividends. I know that for sure. Last couple of years, they don't increase it as much, but they don't cut it either. So that's not accurate. So you're gonna have to take that with a pinch of salt. 5-year growth rate of 3%. They have increased that dividend for 28 years, but somehow they've cut. So that's again inaccurate. So when it comes to the UK companies, it's quite difficult to get the dividends. I use Dividend Max, but sometimes they don't give you the safety and so on. So I'm going to stick with the information that Simply Safe Dividend provided. $1.91. Safety is 75%, sorry. Profit margin 13%. Return on equity 41%. Actually, when it comes to free cash flow, $6.5 billion, which is absolutely amazing. 5% return in the last 10 years. Growth estimate for next year wasn't there in Yahoo Finance, but next 5 years they're expecting about 5%. 13% growth, so 13% discounted right now. $56 per share is where they think the price should be. Next one is Thermo Fisher, the company that we talked about quite a lot, is in pharmaceutical and healthcare company. $205 billion. Current price is 538. PE 35. Dividend is almost non-existent, but it's actually growing, which is nice. So the last 5 years they've actually grown about 15%, which is double digits, very nice. You get $1.40 for every share of this company that you own, and safety is 72%. Profit margin, return equity 13%. Free cash flow 6.5. Total return in the last 10 years, we're looking at about 17%. Growth estimate for next year, 2%. Then 2% after that for the next 5 years. 11% discount right now. 600 is where they think the price should be. Next one is another one that I own in the portfolio. That's RB. $50 right now. 50 billion market cap, sorry. And the price right now, about $70 per share. P is quite low. 3.3 dividend yield. The dividend safety and all of that was not there. Of course, $2.34 is what you will get. In terms of profit margin, return equity, absolutely no issues with that, absolutely fine. Free cash flow, $2.6 billion, and total return the last 10 years as well, 1.5, and then growth estimate for next year is 5%, then 2.5, discounted right now about 12% according to Morningstar valuation, and $80 per share is where they think the price should be. Next one, another UK based company, AstraZeneca, one of the biggest UK and probably one of the best out there. 212 billion market cap, wide economic moat, $68 per share right now, PE of 36 to, I'm not sure if this PE is correct, by the way, because this comes from Google Finance, but I'm not sure. I'm going to have to look at HL to see if that's actually accurate. 2.2% right now, payout ratio 40%, dividend yield latest was 1%, 5-year growth rate of 1%. 2 basically years of increasing that dividend, $1.42 is what you get. Again, this information comes from Simply Safe Dividend. Safety 70%. So in terms of profit margin, return equity, no issues there. 6.9 billion market cap. Free cash flow right now 11% in terms on total return in the last 10 years. And when it comes to growth for the next couple of years, 16% and 13% for the following 5 years, which is amazing, which is one of the reasons I'm investing heavily on this company. 12% discount right now, $78 per share is where they think the price should be. Another company, that's a French company, Sanofi, which is a pharmaceutical company, healthcare company, 128 billion market cap, wide economic moat, $51 per share right now, 13 PE, 3.78 dividend yield, 44% payout ratio. Latest increase was 7%, 5-year growth rate of 3%, 23 years of increase in that dividend, which is quite nice. $1.90 is what you will get, 90% safety. In terms of profit margin, return equity is excellent. $9 billion of free cash flow right now, total return 3% last 10 years. And the next year, they're expecting the earnings to be almost flat, just minus 1%. Then after that, 7% every single year moving forward. 16% discounted, $60 per share, $61 per share is where they think the price should be. Now, there you have it. That's the 10 companies I wanted to share with you guys today. As you can see, there are some quality companies out there. So not everything is going to the moon, just like the Nvidias and technology companies. And now a lot of you are into the semiconductors and technology companies. But there are some other companies out there that are doing really well that could potentially be like a foundational stocks in your portfolio. I do own Visa, Medtronic, Unilever, AstraZeneca and RB in my portfolio. I'm going to share that with you guys in a second. But if you're really interested in any of these companies and you want to learn more about it, just let me know. Drop a comment on the section, and then I will on the comment section, and I will do a bit more research onto these companies, and I will share that with you guys. Right, so starting from AstraZeneca, as you can see here, I do have 30 shares of AstraZeneca here. I also own, I can show you Medtronic, 54 shares in there, almost 55 shares. The next company is RB, which is again 68 shares that I own of this company, and Unilever I own 100 shares, as well as 20 shares of Visa. So the 5 companies that I've actually included in here that I own are them there. So again, the portfolio is doing okay. Things are absolutely fine so far. You know, as usual, it goes up and down every single week. I'm not really interested. I'm not really worried about. I'm getting paid every single day as what we go along, because free cash, the free funds right now, that £13 came from actually Merck today. So Merck has actually paid the dividends today. So yeah, so again, I'm going to collect that dividend. I'm going to keep buying quality companies and holding the long term. And if you are investing in the stock market, I wouldn't worry about these kind of things. You will see this sort of a thing on a daily basis, where Nvidias and so on will go up 4%, 5%, and then go on down again 6-7%. A couple of days ago, this whole section was red and this whole section was green. And this healthcare side of things are switched again. So this kind of thing happens on a daily basis. I hope you're learning a lesson from this by just saying, you know what, I'm going to invest for the long run, and I don't care what happens to these stocks in today and tomorrow or next day. Inshallah, I hope you gain something from this. If you have, like the video, subscribe to the channel, join us on the Patreon account, that will be absolutely helpful. Have a wonderful day. Assalamu Alaikum.